In this video, I'm going to be covering the best way to structure your agency for tax savings in 2026. So this is going to be the 500K to $5 million per year agency structure that is going to move you from basic to advanced tax setups. That way you're paying the least amount of taxes possible, your assets are protected, and if you want to exit in the future, you're in the best position to do so. So the thing that's going to save you the most money on taxes in 2026, it has nothing to do with some S corp hack or some crazy tax hack. As much as I'd like to sit here and say that, it would make my job a lot easier if that was the case. It's just not the reality. The reality is, if you want to actually reduce your tax burden and build real wealth as an agency owner in 2026, you need the right structure in place, which most agency owners that I talk with, they just don't have that. A lot of times it's either extremely basic or it's way too complicated for their level. So in this video, I'm going to take you through the 4-phase progression from starter to advanced setups and the exact decision framework we use so that by the end of this video, you know exactly where you are and what your structure should look like right now. And so if you don't know who I am, my name is Kyle Svenson. I'm a licensed tax professional helping agency owners. I've helped multiple agency owners save 15K to 50K plus in taxes and structure their entity setup better. If you want help implementing anything in this doc, or you want to pay less taxes in 2026, you can get started with a tax savings assessment call. The link is going to be in my bio for that. So here's what most agency owners get wrong about structuring. They think tax savings, it just comes with more entities. So they might see someone who's at $3 million a year and they have a specific entity set up and it works for them, but they might be at 750K per year, less than $1 million. And if they were to replicate that setup, it wouldn't make sense and it might just be overkill for them. Or even worse, someone might be in the same structure from year one. They might be in year 3 now making multi-millions of dollars and they never change because their CPA never told them to change and they could be losing thousands and thousands of dollars. So the truth is, it's not about how many entities you have. It's more about matching your current setup to what your revenue level is, what your risk profile is like, and any long-term goals that you have. And there are 4 distinct phases you'll move through as you scale. I'm going to walk you through each one of those. So phase one is the foundation level. So this is from $0 all the way up to 750K per year in revenue. So what this looks like is you got revenue on this side and it comes into this single member or multi-member LLC that you as the owner or you and a partner both own together. From there, that money gets distributed out and it might fall into different accounts. So you might have an operating expenses account, a taxes account, and an owner pay account. Really basic setup, and you don't need really anything more than that at this level. So what most agencies get wrong here is they actually overcomplicate this. They might set up an S corp, maybe even a management company, and sometimes a holding company before they have really meaningful profit. All that's going to do is add filing fees, compliance costs, and just a lot of confusion around your setup. So what getting this right unlocks. So if you do this right, instead of messing it up, you can get just clean financials, predictable cash flow, and a foundation that you can actually build on. You really don't need anything complicated here. You want it to be simple. At this stage, keep it simple, one operating entity, one or more owners, and one profit engine. And when you're setting this up correctly, you get to do the following. You can start separating operating cash, owner's pay, and tax reserves into separate accounts so that they're not just meshed together into one. You get clearer on when you can spend on things, when you can save, and when to pull cash out. And you can make profit a lot more predictable because of the first two. So how you make that change, if you're under 750K, you have multiple entities, please simplify that down to one. All you'll really need is an LLC and then eventually elect an S corp once you're past probably 300K a year in revenue. And you can hit phase 2 once you reach 7 figures. Keep phase 1 until then. So with phase 2, this is the optimization level. So this is from about 750K per year to $1.5 million a year. And what that looks like is revenues coming in. Now you're an S corp. So you could just be a straight S corp, or you're an LLC taxed as an S corp, which you and any other owners own. From here, the money starts to get distributed. You might still have an operating expenses account, taxes account, now it's a little bit different because instead of just having an owner's pay account, you can pay yourself as a salary and you can also pay yourself in profits or distributions. And when you start implementing tax strategies at this level, it starts to mitigate things in the taxes account. So you don't have to pay as much out of it, which is nice. So, where most agencies go wrong here is that they're still taking random distributions with no strategy. Usually, they already have an S Corp at this level, but there's no optimization here. They don't separate earned income from their return on ownership, and they think that tax planning just means maxing out an IRA or a 401k, but it goes a lot deeper than that. What getting this right unlocks, this is the first time that your entity structure starts shaping how income is characterized, not just reported. And so, what I mean by that is income now has two paths that it can go out: your owner salary and owner profit or distributions. This phase is going to start to introduce timing control when during the year you want to take these, character control, how they are categorized, and then your first layer of tax efficiency, because now you don't have to pay that self employment tax that you would have if you were just a regular LLC. So, how you make that change is you work with someone who can model those owner pay scenarios, looking at reasonable comp for yourself, and then you shift the rest of it into profit distributions and start layering on tax strategies like retirement strategies that make sense at that income level. That's really all you need, and you will see significant savings from that. You move into phase three once the income starts to be consistent and it's high enough that risk and optimization is now going to matter more than cash flow. So that's what happens at phase three. So phase three, I call segmentation. This is when you're at 1.5 million to about 3 million a year in revenue. So here's what happens. You're going to start to split your company structure into two things. Revenue is going to start going into your operating company. This is where all of your client fulfillment work gets done. Then from there, money's going to be shifted into the management company. This is where leadership and others are managing the operating company. So the operating company pays the management company a fee. Then from there, money still flows into operating expenses, taxes accounts, and then the profits get distributed out from these two. And still, you have tax strategies here, which are still lowering the taxes account there. So the main thing here is we're going to start to split up that S Corp into one or two of them. So, what most agencies get wrong here is they keep everything in one entity. Even though the business is now having real operational risk, they have brands and systems that are starting to be worth something. They have a lot of big case studies, and they might even have IP at this level. And one lawsuit could really start to threaten everything that you've done. So, let's get an example here. So, let's say you're an agency doing 2.4 million a year in revenue, and all client contracts are in one S Corp. An unhappy client, let's say they threaten to sue you, your attorney warns that if they win, they could pierce the corporate veil and go after personal assets because there's no true separation here. Without proper structuring, that one bad scenario, it could put your house, your savings, and a lot of other things at risk. You just don't want to have that risk at this level. So, what getting this right unlocks at this level, structure becomes about managing risk and having strategic flexibility. And really, it's about that risk management. You don't want to put yourself out on a limb and cost everything that you've built at chance. So instead of one entity doing everything, now you have two. So you have an operating company that focuses on execution and client delivery. And you have a management company that provides services to the operating company, leadership, strategy, admin. Money flows between entities by design in this case. So what this means now is that you get cleaner margins per function. You can see it at each level, and you get lower risk exposure if the opco gets sued. So that helps you a lot, and you can start to intentionally profit place things. So instead of profit just going to one or two accounts, you can just intentionally split it up in better ways. So how to make the change? You start by isolating the highest risk function. Usually that's going to be client delivery in this case. And then you want to have a management company contract with the operating company for the leadership services. This is the part where the business becomes exit ready, even if you never sell. It starts to become an asset that lives and breathes without you and also without putting you at risk. The entity starts becoming the one that takes on all the risk. So then, once you get past that, phase four is preservation. This is when you're starting to really scale. You're hitting 3 million, 5 million, $10 million per year in revenue. You need another structure for this. And this is what the structure is going to look like at this level. So, what you're going to have is now you're going to introduce a holding company into the mix. Revenue is going to come in. You still have that operating company and the management company. From there, all cash flow that these have is going to allocate to the holding company. And then the holding company is owned by you and any of the other owners. And then the holding company is going to allocate cash flow down to different accounts. So, distributions account, any asset purchases the business wants to make, reinvesting into different things, and tax strategies as well. So, instead of it being the operating company and management company doing a lot of the work, now you have another entity layer in here. So, what most agencies get wrong at this level is they think that they've made it. And so they stop evolving. They think that they can just have a simple structure and that it'll work. And they don't separate ownership from operations. And this leaves wealth sitting inside operating entities that's exposed to lawsuits, creditors, and tax traps. So here's an example, especially for the tax traps part. So let's say an agency owner at this level, they sell for $4.2 million and they've kept everything in one S Corp. They take the full gain as ordinary income because it flows through to them. They pay 1.4 million in taxes when maybe if they structured it a little bit better, they could have saved 600K. So in this instance, that's over $500,000 left on the table just because their structure wasn't set up correctly before the exit. So at this level, structure is a lot less about savings and more about control, unless you're exiting in this case. The goal shifts from making money to keeping it. Now, your net worth at this rate might be growing a lot faster than your income, so the legal, tax, and life events that start to come up matter a lot more. Here's what this is going to look like. It's going to have that holding company at the top. The holding company is going to own the operating company and management company, and the founder controls the operations, but they might not necessarily own the whole thing. And ownership and operations are no longer the same thing. They are separated at this level. The operating entities generate cash, and cash flows up to the holding company, and the holding company, again, allocates that capital via reinvestments, distributions, and asset acquisition. Personal assets are fully outside of the risk scope here. So how do you make the change? This is where it starts to become a little bit more complex, and you need to bring in a tax strategist and an attorney who specializes in holding company structures. You're going to want to map out your 10-year plan. Are you planning to sell it in 10 years? Are you going to pass it down to someone? Are you building it into a portfolio? The structure for that outcome, you want to start structuring it for, not just this year's tax bill. This is when you start to think really long-term, decades out potentially. This phase is going to optimize for asset protection, exit flexibility, and long-term tax control. So when we put this all together, here's some of the insights that you can gather from it. Each phase solves a different problem. So the first phase, the foundation one, the main problem that happens here is chaos. You don't know what you're doing, you don't know where the money's going, and you need to start simplifying it so that you understand where profit goes, where expenses go, and you don't get hit with surprise tax bills. I see that a lot at this level. The next one, optimization. Big thing here is tax drag. So as you start to get really high income at this point, your taxable income is also going to rise, and you need to do things that are going to lower the tax liability. The third thing here for segmentation, the main problem here is risk management. You're going to be exposed to different things, different asset risk things that come up, and you want to manage that. And then fourth is preservation. So the primary problem is wealth exposure. Mainly if you want to sell, you need to start preparing for that. Or when you pass it down to family or an employee, all of those expose your wealth at that level. So most agencies I see fail mainly because they stay in phase two forever. That's all that they do with their tax setup and they leave it as is. Their CPA never tells them to evolve into maybe something more, and they think tax planning just equals deductions. So the question you need to answer isn't what entities should I have? You need to start asking, what phase am I in and what should my structure look like right now, not 5 years ago? So those are the 4 best entity structures for agencies. These are working in 2026. You're going to want to pick one of these for your agency going forward. So look, the information in this video is genuinely powerful and it can help you save six figures in taxes and build a more valuable, sellable business. At this point, you have two options. Option one, you can try and implement everything by yourself, spend the time, money, and headache of figuring out entity structuring, reasonable comp calculations, risk mitigation, and exit planning step by step, and all of the problems you will 100% face if you're doing this for the first time or you're working with an inexperienced CPA. Option two, you can get help from someone who's building these exact structures for agency owners right now, has solved problems that you'll probably face, and can get this right the first time. And if we're being honest, if you're not already structured correctly for your revenue level, then you 100% need help. That's why I want you to click the first link in the description and book a tax savings assessment with our team. What we'll do on that tax savings assessment is we'll review your returns, project your current year liability, and build you a 12-month tax savings plan so you know exactly what phase you're in and what needs to change. This is for you if you're doing at least $50K per month in revenue, you're tired of reactive tax prep and traditional CPAs, and you want a team of experts who can help you structure, plan, and execute everything here and more. If that sounds good, click the link in the bio, book your assessment, and I'll speak to you soon. And make sure you like this video so you can easily find it again. Subscribe to the channel for more videos on tax strategy and smart financial decisions for agency owners, and I'll see you in the next one.